In this video, we're gonna talk about the interest expense, income before tax, and finally, and most importantly, net profit. We're going to deep dive into each one and give you some more insights, such as what we can conclude by seeing the taxes paid by a company or its profit. Firstly, we start with the interest expenses, and it is basically the interest paid during the year on the debt that the company carries on its balance sheet as a liability. This is called a financial cost, not an operating cost, and it is isolated out on its own, because it is not tied to any product or sales process. Instead, interest is reflective of the total debt that the company is carrying on its books. The more debt that the company has, the more interest it has to pay. Companies with high interest payments relative to operating income tend to be one of two types. A company that is in fiercely competitive industry where large capital expenditures are required for it to stay competitive. Or a company with excellent business economics that acquired the debt when the company was bought in a leveraged buyout. We can use Procter Gamble and Goodyear tires as examples here. Procter Gamble has to pay a mere 8% of its operating income out in interest costs, where Goodyear has to pay on average 49% of its operating income out in interest payments. Here you can instantly spot who carries more debt relative to its operating income. As a rule, companies with durable competitive advantage all have interest payouts of less than 15% of their operating income. Let's take the investment banking business as an example, which on average makes interest payments of around 70% of its operating income. Back in 2006, a careful eye would have picked up the fact that Bear Stearns reported that it was paying out 70% of its operating income in interest payments. But by the quarter that ended in November 2007, its percentage of interest payments to operating income had jumped to 230%. This means that it had to dip into its shareholders' equity to make up the difference. In a highly leveraged operation like Bear Stearns, that spelled disaster. By March 2008, the once mighty Bear Stearns, whose shares has traded as high as $270 the year before, was being forced to merge with JP Morgan for a mere of $10 a share. We can conclude here with a really simple rule. In any given industry, the company with the lowest ratio of interest payments to operating income is usually the company most likely to have competitive advantage. If you find my content valuable, please subscribe. It helps me keep creating more of what you love. Secondly, I would like to go through gain or loss on sale of assets and other. When a company sells an asset other than inventory with which it's generating revenue, the profit or loss for that sale is recorded under gain or loss on sale of assets. The profit is the difference between the proceeds from the sale and the carrying amount shown on the company's books. Quick example here: if XYZ company had a building that it paid $1 million for, and after depreciating it down to $500,000, sold it for $800,000, the company would record a gain of $300,000 on the sale of the asset. Likewise, if the building was sold for $400,000, the company would record a loss of $100,000. The same applies for other, where non-operating, unusual, and infrequent income and expense events are netted out and entered onto the income statement. Such events would include the sale of fixed assets such as property, plant, and equipment. Also included under other would be the sale of patents if they were categorized as outside the normal course of business. Sometimes these non-recurring events can significantly add to a company's net profit, so we should be careful with them and investigate if that has an actual significant effect on the net profit of the firm. We continue with income before tax. which is where all of the company's expenses have been deducted, but the income tax hasn't been paid yet. When taxes are paid, they are recorded on the income statement under the heading Income Taxes Paid. Now, what is interesting about the income taxes paid is that the line item reflects the company's true pre-tax earnings. Sometimes companies like to tell the world that they're making more money than they actually are. Shocking, isn't it? One of the ways to see if they're telling the truth is to look at the documents they file. Take the number they list as pre-tax operating income, deduct the percentage that the country in which the company operates charges them for tax. In this case, I will give you an example with the United States, which is 35%. And if that figure doesn't match the amount that the company reported as income taxes paid, we had better start asking some questions. The beauty of a company with a long-term competitive advantage is that it makes so much money it doesn't have to mislead anyone to look good. And finally, after all the expenses have been deducted from a company's revenue, we get the company's net earnings. In here, we should take a look if the net earnings of the company are showing a historical upward trend. A single year's entry for net earnings is basically worthless. We should be interested in whether or not there is consistency in earnings picture and whether the long-term trend is upward. So, while the total revenue number alone tells us very little about the economics of the business, its ratio to net earnings can tell us a lot about the economics of the business compared to other businesses. A business like Coca-Cola earns 21% of total revenues, which is considered fantastic. The amazing Moody's earns 31%, which reflects these companies' superior underlying business economics. But a company like Southwest Airlines earns just 7%, which reflects the highly competitive nature of the airline business, in which no airline company holds a long-term competitive advantage over its competitors. A simple rule with a few exceptions is that if a company is showing a net earnings history of more than 20% on total revenues, there is a real good chance that it is benefiting from some kind of long-term competitive advantage. Likewise, if a company is consistently showing net earnings under 10% on total revenues, it is more likely that it is operating in highly competitive industry or it's just not doing well. This of course leaves an enormous gray area of companies that earn between 10% and 20% on total revenue, which is just packed with businesses ripe for mining long-term investment gold that no one has yet discovered. One of the exceptions to this rule is banks and financial companies, where an abnormally high ratio of net earnings to total revenues usually means a slacking off in the risk management department. While the numbers look enticing, they actually indicate an acceptance of greater risk for easier money, which in the game of lending money is usually a recipe for making quick money at cost of long-term disaster. And having financial disasters is not how one gets rich. If you enjoyed this video, please consider subscribing to my channel for more content like this. Take care and see you next time.